Without further ado, let's start the webinar. For this session, we have Jonathan Wu, Glenn Thum, Ambrish Shah, and Zane to present on the U.S. big tech, U.S. banking sector, and technical analysis. Without further ado, let's welcome them.
Hi, good evening, everyone. Thanks for joining us. In another episode or another session for our US first quarter 2024 outlook. Give me a second while I share my screen. All right, so like as usual, today I have with me my fellow analysts, Glenn, Zane, as well as Ambrish. I'll be sharing a little bit more about not just the US tech sector, but the banking sector as well, and run through a little bit of macro, which will be followed by our usual technical analysis for just the S&P 500 as well as the Nasdaq. Along the way, feel free to just put in any questions that you have in the Q&A tab, and then get to it after we get towards the end of the presentation. So without further ado, I'll just begin. Just a brief disclaimer. In terms of content, we'll run through the fourth quarter's performance, go through some of the macro themes that we're seeing right now, some of the tech sector themes that we are looking out for in the first quarter of this year, and actually for most of this year. Run through our stock picks, and like I mentioned earlier, go through our technical, followed by our conclusion and then the Q&A. So we just take a brief review of the fourth quarter performance. Over here, I put a picture of Red Bull. Essentially, that's what happened during the fourth quarter. Performance was quite unbelievable, actually. When we look at the S&P overall, half of its gains basically came in the fourth quarter. You can see on the left here. While the Nasdaq, as well as your big tech or your FANG companies, did do slightly better, but didn't really outperform as much as the first 2 quarters of this year. Interestingly enough, your interest rate sensitive sectors or your interest rate sensitive asset classes like bonds and gold actually surged quite significantly, and it is mainly due to markets pricing in lower rates moving into 2024 as well as 2025. Likewise, for most of the year, commodities haven't really been doing well. Energy prices have kind of dropped off a little bit, as well as we're not kind of seeing this sort of disinflationary environment in terms of commodity prices across the board. When we take a look at currency, the dollar really weakened versus most major currencies in the fourth quarter, and actually for 2024, actually lost ground on euro as well as the pound, and surprisingly enough, the Sing dollar, while they were ahead of the yen and the yuan for the whole of 2024. And most of the weakness came because I guess people are pricing in a lot of the Fed kind of easing some of its monetary policies, and therefore kind of devaluing the currency a little bit. When you look at some of the individual sectors within the S&P 500, and what actually did well in the fourth quarter, we actually saw that cyclicals were actually starting to recover a little bit. So sectors like real estate, financials, as well as industrials. I mean, aside from your tech and growth sectors, which continue to perform well throughout the year. Energy was the biggest laggard, and this is mainly due to huge dip in oil prices in the fourth quarter. While towards the bottom, you also see a lot of your defensives like your staples, your healthcare, as well as your utilities. When you look at the overall market in 2023, growth was the real standout. You can kind of split these sectors into 3 groups. So the first would be your growth sectors, which 40+% year performance, which is really incredible. Then in the middle band, you've got a bunch of your cyclicals, your financials, materials, and so on. Those are like 10 to 15% performance. And rounding up the bottom, you've got your defensives, your healthcare, consumer staples, and utilities. 2023 was a huge year for AI, and this really showed in terms of AI-related stock performance. When you take a look at your biggest gainers in terms of this AI category, you've got Nvidia, Supermicro, Meta, as well as Palantir. These are like more than doubled their prices, their stock price in a year, which is really crazy. While rounding out the bottom, surprisingly, it's actually big tech, Apple, Microsoft, Google. I mean, these companies did well, but I guess relative to the rest of the other AI-related companies, comparatively weren't as good. That being said, all these stocks far outperformed the S&P 500 by miles. When you look at some of your valuations, just off of the overall market, the S&P 500 forward PE was actually, it's actually heading, or it has actually head into overbought territory. Is more than one standard deviation away from its average of 18 times. So right now it's trading at about 22, 23 times. Essentially how they calculate forward PE is they just take analyst estimates of how the S&P 500 will do in terms of earnings for 2024, or at least for the next 12 months, and basically divide it. And this is divided over by the price. So we still see the S&P overvalued, and we are a little bit cautious on the S&P 500, because of several reasons. Firstly, it's tough to see multiples actually continuing to expand. We saw such a big expansion due to AI in 2023, and when you actually look at the earnings estimates, they haven't actually really been that great. It roughly flat or slightly down compared to last year, and last year was slightly down compared to the year before. So, what we think will really drive markets up would be kind of earnings growth as compared to multiple expansion, and that was essentially what happened in 2023. So when we move into some of our I guess macro themes and what we're looking at right now, market's actually pricing in 6 rate cuts in 2024. The earliest being, I believe, in March this year, so very soon. But when you look at just your core inflation as well as your Fed funds rate, you can see inflation, which is the blue line here, is really started to trend downwards. So it's quite safe to assume that there won't be any more rate hikes. Although we just think that it was a lot easier to get inflation down from 5% to 3%, but it'll be significantly harder to get it down from 3% to 2%, just because when you look at how this is calculated over a year-on-year basis, over the course of this past year, the comparisons versus the year before were actually very easy, whereas it would be a little bit more challenging for 2024 when it has to compare year-on-year versus 2023. We do think it will still continue to fall, although it will moderate a little bit and it'll take a little bit longer to reach the Fed's 2% target rate. You can see right now that the line in orange, which is the Fed funds rate, is sitting around 5.3%. Expectations, are in the next chart, is that there'll be quite a number of cuts happening in 2024, which essentially is your blue line here. You can see each point, after March, just keeps going cut all the way until December, and market expects about 4%, interest rate to hover about 4% by the end of 2024. Interestingly enough, the Fed actually has projected, a slightly higher expectation of around 4.5%. And we think that, it would make sense to actually have about 3 to 4 rate cuts instead of 6 or even 7 rate cuts for this year, based on several reasons. The first, it is kind of, even though inflation has been coming down, it is a little bit too soon to start cutting rates so aggressively. And two, it is also a election year. And so, I don't want to sound too political, but if the Fed starts cutting rates, much drastically, a lot more drastic in the beginning of the year, that there could be some sort of political implications here. Although this, I guess, will be a little bit more muted. So yeah, essentially, we don't think that the Fed will be cutting too soon and too aggressively. What's more likely to happen is maybe if they do cut in March, they'll probably maybe cut once a quarter instead of essentially every meeting, just to kind of taper off the interest rate slowly, rather than aggressively cutting it. And one of the reasons why we also think that this could be happening is because Fed pivots actually don't really bode well for the market. When you look at the previous few instances where the Fed actually cut rates quite aggressively, markets actually tanked quite severely, mainly because something broke somewhere, and markets actually went into a recession. So on one sense, you really do want rates to come down because it makes borrowing a little bit cheaper. Uh, it makes a lot of financing a lot cheaper. But on the flip side, if rates do actually start getting cut too aggressively, there could be an ulterior reason behind it, and that may, I guess, for the most part, wouldn't really bode well for the stock market. Yeah. So our second macro theme that we're seeing is that the labor market right now is actually still very resilient, and still the main reason why markets haven't actually, or the economy actually hasn't gone into a recession. When you look at unemployment rates right now, they're sitting about 3.6, 3.7%. So it's still very, very low, very healthy levels. Kind of the healthy levels range between 4 and 6%. Once you get unemployment above 6%, then things start to get worrisome for the economy on whole. At the same time, the hourly wage growth actually has continued to moderate a little bit. So at the peak of pandemic, the hourly wage growth was almost double digit year on year. Right now, it's fallen down to about 4%, which is still slightly above its long-term average of 3%. And we do think that a combination of tight labor market as well as slightly higher wage growth is actually still one of the reasons why inflation we think will remain a little bit sticky moving forward, at least in the next quarter or two. At least until wage growth and unemployment rise a little bit. It's a little bit ironic that you're kind of hoping that unemployment rises a little bit, just so that the inflation can ease a little bit more. But that kind of is the equation to, as far as we see, as to how inflation can really be brought down more significantly. We look at the third macro theme. What I mentioned earlier also is that we think that earnings will remain fairly sluggish, but we expect it to kind of turn around at least in the second half of this year. Maybe not so much early on. When you look at this chart, it's essentially the line in orange is essentially your S&P 500 chart line, while the blue line is your earnings growth year on year. And what we've seen for the last few quarters is that actually earnings growth has, I guess, not grown. It's actually contracted for the last few quarters. And there are several reasons for this. The biggest reason, obviously higher rates have inevitably slowed down the economy, as well as earnings for companies that I guess aren't big tech and semicons, because they just have to pay off higher interest, which are eating into profitability. So companies are still feeling the lagging effects of this. And at the same time, even though consumer spending and the economy has been fairly resilient, actually demand compared to supply, there's still kind of an imbalance there. And so a lot of companies are still kind of working through this sort of imbalance in terms of inventory, in terms of sales. And so we think that, markets do tend, or rather, they are actually looking to be getting ahead of itself slightly with such a strong rebound that we saw in 2023. Because you can see in this chart, the circled areas are essentially where when earnings growth actually starts to pivot around, then you really start to see a sort of rebound in the market. But right now, earnings haven't really shown strong signs of rebounding, while the stock market has just kind of gone through the roof. So with that, I'll actually hand our next macro theme over to Glenn, who will talk a little bit about the banks.
Hey, yeah, thanks, John. Yeah, so I'll just do a very quick, short sort of overview of the bank's the last few the third quarter results, as well as just an outlook on the 2024 and possibly the fourth quarter as well. Next slide. Oh yeah, thanks. Yeah, so at least we took the four largest banks, and namely JP Morgan, Bank of America, Citigroup, as well as Wells Fargo. So what we have seen is that there's actually pretty healthy growth across all segments. And this is for the third quarter 2023 results. Net interest income, as expected, has risen quite healthily, mainly due to the higher for longer interest rates. And I think if you look further down, you can see the second red box there. The provisions change is also quite a positive because it has sort of normalized to pre-COVID levels. I think in the first half of 23, we could see that provisions have risen quite significantly as compared to the third quarter. So this is a sign that the banks are now more confident, and they are also feeling that they are well capitalized as well. And the second point would be the loans growth. So despite the higher interest rates, it's interesting to note that loans has actually grown for 3 of the banks, and with only Wells Fargo dipping slightly, -1%. So it's actually quite stable. So this is a good sign for the banks going into 2024. And resultantly, if you look at the PATMI or earnings for the banks, it has all risen quite healthy. It's ranging from 2 to 65%. So an average, I mean, all the banks have shown double-digit growth in earnings. So now, just for quick pointers on the outlook for 2024, I think it will be a very challenging time for the banks in the US, namely the interest rates, as John was speaking about earlier, that it's expected to dip quite a lot in this year. And this will not just impact the bank's net interest margins, but their funding costs will also be kept higher because for the larger banks, not so much of an issue, but for the smaller and regional sort of mid-sized banks, they would have to retain their customers by still giving good good deposit rates, and this will sort of mean that their funding costs are heightened. So this will be quite a challenge for the smaller and the middle-sized banks. And the second point going to 2024 would be the loans growth. So with the interest rate at the peak, the banks have sort of not really seen loans growth as high as it was when interest rates are very low. So when the rates start to cut, it will still be at elevated levels, and we would probably not see loans growth as high as it was, but it'll be more positive as compared to 2023. And I think the last point I'd like to bring up for 2024 would be the non-interest income. So we know with NIMs being muted and loans growth sort of pretty slow and flat, I think the banks will be looking at their non-interest income and more particularly their fee income, which will help to grow their bottom line as well. I think that's all I have for the banking sector, and now I'll hand it back to John. Thanks.
Thanks, Glenn. So with that, we'll move on to some of the tech sector themes that we're looking out for moving forward. The first is EVs. It's been a hot topic for, I guess, a year or so. Obviously, we think, and it's quite evident that it's coming down to be a two-horse race for EVs, mainly between Tesla as well as BYD. Interestingly, when we look at total EV deliveries, this number actually continues to climb. You look at, I guess, the compound annual growth rate over the last few years is like 90%, almost 100. It's basically almost doubling each year, which is expected because of, I guess, the nascency of the industry. It's really only picked up, I guess, post-COVID or right around when COVID hit. Which is good because on one hand, they are an industry, they are sort of a sub-industry under the whole automotive group. So what we really want to see from EVs is for them to continue gaining share on the broader automotive market, and that's kind of what they're doing right now. I think that obviously this trend will continue to prevail moving forward, especially with China leading the way. They're continuing to push EV cars, and when you look at the volume of EVs that are coming out of China, especially from BYD, it's quite astounding, especially from where they started just a few years ago. Deliveries were relatively small. When you look at what's really to come over the first quarter, we do think that it's quite interesting because even though fundamentals actually improved for these two companies, their stock prices are actually not really moving so much if you look back to the end of 2020, beginning of 2021. Both these companies' stock price, basically gained about 7-8%, which is very marginal for an industry that's growing basically 2x every year. And so one thing we're actually looking out for is essentially a larger move for EVs, a larger, more sustained move, and we think that this could be coming relatively soon. We think a big reason for why these companies actually haven't performed in the past couple of years is because and even so right now, there's ongoing price wars for EV cars in especially in China, but across the world as well. So these price wars are essentially eating the margins because there are a lot of players that are trying to grab market share at the cost of profitability. And what we're seeing right now, moving across from 2023 into 2024, is that these kind of price wars are actually dying down a little bit. And a lot of, well, not a lot, but some of the smaller players in the EV space are being basically bought over by some of the larger players. So they're starting to see some sort of a market consolidation in this space, even though it's still early days. We do think that margins, and because profitability has been impacted, because margins have impacted, investors have been a little bit more hesitant to investing in these kind of companies, especially with the multiples still remaining fairly elevated. But moving forward, we think that margins should stabilize due to three reasons. The first thing, we are seeing a moderation in raw material costs. So your raw materials for whether it be lithium or nickel or copper and whatever is used to basically manufacture an EV, these prices are coming down. In theory, this should help margins expand for a lot of these companies because your cost to manufacture goes down a little bit. Secondly, like I mentioned earlier, a majority of the price cuts have actually taken place already, barring some of the Tesla models that recently just had a price cut before 2024 because a lot of their federal tax credits were expiring, so they needed to move these cars on. Other than that, we are also expected to see continued improvements in cost for batteries. So all this actually leads to essentially improvements in manufacturing costs, which if prices remain the same, right, instead of them consistently cutting every month or every 2 months, in theory you should see margins help to expand. And this should actually help the industry moving forward because it's showing signs of, I guess, some sort of stabilization, where you've got your big players kind of established and looking to scale a little bit more. And we think this should help the industry. We think that this could happen as soon as first quarter of this year, or maybe the second quarter of this year. But either way, when you look at some of the multiples that Tesla and BYD are trading, I mean BYD I think right now is trading like 15 times or 20 times for PE, which is I dare say it is quite undervalued given that over the last few quarters their both their gross margin as well as their net margin has continued to improve. A little bit of the opposite for Tesla, but given that they are a little bit more on the premium side, even though their margins have been cut into a little bit, there's still a lot of upside because they aren't just a pure EV company. You've got your software, I guess, component to it. You've got your batteries or your I guess sustainable energy sources component to it. So that should help to drive margins a little bit. And we think that both are fairly. I guess for Tesla we think that fair price, but for BYD there is some sort of it is heavily undervalued because we believe there's quite a bit of pricing discounts that investors have given just mainly because BYD is a Chinese company, and what we're seeing across the board for most Chinese companies is that they are trading at huge discounts to some of their I guess non-Chinese peers. So yeah, overall for EVs we think that prices should be set to move either in the first quarter of this year or second quarter of this year, especially with earnings coming out. We do expect fairly healthier earnings and a much more stable outlook from these companies as they look into 2024 and 2025. The second tech trend that we're seeing is semiconductors, and we're seeing sort of most of these semiconductors are recovering slowly. Of course, the big, when you think about semicons right now, the main guys you're going to be thinking of is Nvidia and AMD, and this is really just a small portion of the overall semiconductor industry. And I dare say that these two companies are essentially driving most of the growth for right now and the recovery. So they're essentially pulling along the rest of the industry. When you look at this chart, it's just semiconductor worldwide revenue. The blue line is the trailing 3 months compared to a year-on-year basis, as well as and the orange line is the trailing 12 months combined accumulated revenue on a year basis. What we're seeing, right now is that basically your trailing 3-month revenue is almost recovered to, from a sharp decline to now it's almost a flat year-on-year, which is a good sign. While the 12-month trailing number is kind of lagging, which is quite usual if you see in this chart, the kind of ebb and flows of how cyclical industry like the semiconductor industry operates. And so we think that as a lot of the other semiconductor components like your memory, your equipment, and all of them, one thing that we note from them is that these companies look to have bottomed out, and they are starting to sound a little bit more upbeat in terms of looking forward in 2024. Although, the expectation is that the recovery won't be as sharp and it won't be as crazy as what we saw with Nvidia and AMD, which is okay. It's just kind of the nature of the industry as a whole. Just because there's demand, supplies usually for a lot of the components, it does take some time to ramp up and to meet the demand for it. But otherwise, we do think that the worst is over for semiconductors. And we do think that as a whole, the industry should be a lot more healthier moving forward. We should be great for both semiconductor companies in general, especially for AMD and Nvidia. Moving into our next sector theme, we're going to talk a little bit about digital advertising. We think that they're really poised for a good year ahead. There's sort of a recovery going on already. Look at this chart. It's the last 12 months in revenue for digital ad companies, essentially your Meta, your Google, Pinterest, Snap, and so on, and even Amazon's advertising department. What you can see over the last 2 or 3 quarters is sort of a recovery. So similar to semicons. And this is, because the economy is a little bit more resilient. You had this huge hesitation in 2022 and 2023 about advertisers not really wanting to advertise because they're very concerned about global kind of a meltdown in the global economy. These kind of fears have dissipated a little bit, and so advertisers are a little bit more on the front foot. They're willing to kind of put the money out there. At the same time, AI has actually played a huge part in improving the efficiency and making, I guess, a little bit more attractive for advertisers because they're able to get high returns on their dollar, which is essentially what they care about. And so it's really driving increased efficiency as well as increased CPM, which is cost per 1,000 clicks. When we look at election years and how this really relates for digital advertising companies, you can tell, just put 2 companies here, Meta and Google. The shaded portions are election years. And generally, over I guess just the last two elections, because you take a look at the previous election, I'm not sure I think Meta had just listed, so there wasn't really a fair comparison in terms of stock price. But you can see quite clearly that over election years, digital ad companies do well. And the biggest reason is because political campaigns advertise a lot more during on social media during these years, and they're pouring in billions of dollars to kind of garner votes, especially in the US. And so we think that for 2024, it should be no different, or maybe it be even spending might be even higher than previous years because of the increasing number of independent candidates, as well as it's not really that clear cut as to who will represent each the Democrats or Republicans moving forward for this election year. So we think that just because of this and the improving fundamentals of digital ad companies, we do think that for the year ahead, it should be a good thing for Meta and Google especially. So that's all on my end. For the next, I guess, tech sector theme, I'll hand it over to Ambrish to kind of run through the SaaS companies, and he'll follow up with moving into 3 of our 6 stock picks. So Ambrish, back to you.
Thank you, John, and good evening, everyone. So moving on to our next sector piece, which is SaaS. Next slide, please. So it's basically an abbreviation for software as a service companies. And basically, so SaaS companies, they deliver their products or applications over the internet via cloud. And they have a subscription-based business model. And because of this, they have visibility over their revenues, and they are more recurring in nature. So basically last year, major tech companies, software companies like Microsoft and Salesforce, they had faced impacts from macro uncertainties and the cautious IT spending. However, going into the first quarter 2024, there are signs of recovery. So for instance, basically most of these companies, they have enhanced their products, and they have also integrated AI across their product base, and they should boost the demand for their products. So we basically, based on the functions, we divided the SaaS market into 3 segments, and we considered the top companies amongst them. So if we take a look at the green chart, green line, it's basically for the productivity segment, and it includes the players like Microsoft for its Office 365 and Adobe. And we can see that for most of the previous few quarters, it has remained resilient, and it's the first one to lead the recovery. And this is mainly because the demand remains strong for productivity applications that basically provided solutions like generating documents or spreadsheets or even editing digital content. So with the digital trends, the enterprises, they have not cut down their spending on the productivity applications in order to remain competitive. Whereas for the CRM segment, which is in the red line, and the blue line for the ERP segment, they seems to have bottomed out. And we believe that going forward, any cautious IT spending, it would be offset by the demand for the AI, which would boost the demand for its products. The AI should boost demand for its products and the top line growth. So any cautious thing, it should have been offset by the strong demand. So going forward, we see a recovery in software market. Next slide, please. So moving on to our stock picks, we basically have 6 stock picks for the first quarter of 2024, and we will be starting with Airbnb. Next slide, please. So for Airbnb, it's basically an online marketplace for unique homestays and market stays, for stays and unique experiences. And for Airbnb, it has reporting a record high booking volumes, and this is mainly because of rebound in travel. So for instance, in FY 2022, the company, it has already surpassed its pre-pandemic levels. And whereas going forward in the next 2 years, we expect the booking volumes to grow by about 14% CAGR. And this is mainly because of the surge in travel demand. So we would like to highlight 3 key trends that Airbnb is witnessing right now. So first of all is that guests are staying longer on Airbnb, on the platform, on the properties, and so basically the company highlighted that 20% of its booking volumes, they are towards stays which are for 28 days or more. And this is mainly because of higher flexible remote work environment and flexible work environment. Secondly, guests, they are traveling more cross-border international trips, and specifically to the Asia Pacific regions. And as the COVID restrictions, they are eased now. And lastly, guests, they are returning back to the urban cities. And secondly, the Airbnb, its business is getting more profitable. So for FY23, it's expected to report a net profit of about $5 billion as compared to 2 billion in FY 2022. And this is mainly because of the top line growth as well as high operating leverage. And the active listings on Airbnb's platform, it has also been consistently increasing. So for instance, in the third quarter, it reported listings, the active listings, they grew by about 20% to about 7 million active listings. And this is mainly because the company, it has been continuously adding in new features and updating their platform. Last year, they introduced various features for instance, the host, they can share just their rooms and not the entire property. So Airbnb rooms as well as monthly stays, and also they introduced a few pricing tools which can help host. So the host, they can, through these tools, they can get to know what would be the competitive prices charged by the other hosts in the similar regions. So it has consistently upgrading and introducing new features, as well as it's providing support to the hosts. And also hosts, they are turning on to Airbnb to earn additional income. So but basically, Airbnb, in terms of risks, we believe that for FY24, we believe that the daily rentals, it should remain under pressure, the average daily rentals, and this is mainly because the business may shift towards the urban cities. So basically, urban properties, they are smaller in size, and as a result, the daily rentals are on a lower side. So this should impact the daily rentals for Airbnb. And and also, for Airbnb, another challenge would be that if the economy goes into the recession, or if there is any pullback into for the consumer discretionary spend, then it might impact its booking volumes. But overall, for Airbnb, we have a buy recommendation with a target price of $157, and we believe that it's the leader in this space, and it's well positioned to benefit from shift to alternative accommodations, as well as it's more group and family travel friendly, as well as it's asset light business. Since Airbnb, it's just an online marketplace and it does not own the properties. It's asset light business model. So overall, we have a buy recommendation for Airbnb. Next slide, please. So moving on to my next counter, Microsoft. So for Microsoft, we have we believe that there are two key growth drivers. So first of all, it's intelligent cloud segment, which includes its cloud service Azure, whereas the second growth driver would be its productivity and business processes segment, which mainly includes its Office 365 productivity software. So for Azure, it currently has a market share of about 23%, and it has doubled over the last 5 years or so. Whereas the biggest public cloud provider, it's the AWS, Amazon's AWS, and it has a market share of about 33%. Whereas Google Cloud, it has a market share of about 10%. So we believe that Azure, it should continue to gain market share mainly because of digital transformation trends. As the companies, they shift their workloads to the cloud, Microsoft should benefit from these trends. Essentially, all the three top players should benefit. But specifically in terms of Microsoft, there are other benefits, like they have a pricing advantage over AWS, and also its integration capability with Office 365. And also, the 80% of the personal computers Windows have been installed. So since the customers, they already have a partnership, like a relationship with the existing Microsoft, so they might prefer to go ahead and buy Azure instead of another provider. And also Azure, it's a high margin business. So essentially, any boost in Azure's sales, it should help Microsoft to increase its bottom line profitability. And secondly, in terms of its Office 365, so Microsoft, it has a 90% market share in the global productivity market, which includes its Office 365 and Teams software. So despite the significant market share, Microsoft, its Office 365 commercial revenue, it has been increasing by about 15 to 16% over the last few quarters, year on year. And this is mainly because the demand, it has been coming from small and medium enterprises, as well as the frontline workers, as there is more need to manage the daily tasks and workflows. So and another the driver would be that Microsoft, the Office 365 has consistently my company has added in new features, and it has now recently integrated AI across the Office 365. So wherein through Word, through text-based prompts, we can generate the content, or through PowerPoint can generate the first draft of presentations. And it has started to recently commercialize that by charging $30 per month. So the company, it has highlighted that it should significantly boost productivity for its users, and it's gaining traction. So the company, it should continue to grow its Office 365 revenues in double digits over the next few quarters. And lastly, it's more personal computing segment. It has been declining over the last few quarters, but this mainly because of the weak PC demand. However, for the current quarter, for December ended quarter, company highlighted that the PC demand, it has now stabilized, and the segment's revenue, it should grow. It should return to a positive growth rate, mainly because mainly because the stabilization in PC demand, as well as its gaming segment revenue, it should witness a significant revenue boost, mainly because it has recently acquired its acquisition Blizzard, a gaming company. So it should boost its gaming segment revenue, and it should help to boost its more personal computing segment revenues to a positive territory. So overall, for Microsoft, we have accumulated recommendation with a target price of $375, and we believe that it's well positioned to benefit from digital transformation trends. And these trends, it should basically help to boost the demand for its products like Azure and Office 365. Next slide, please. So moving on to my last topic, Salesforce. So basically, Salesforce is a SaaS company, and it generates about 90% of its revenues through subscriptions. And Salesforce, it basically helps companies to manage or handle their sales operations and automate them, and also to provide better customer service relationships. And recently, it has also expanded into the marketing and data analytics solutions. So for Salesforce, the demand has been strong for its core products, which are Sales Cloud and Service Cloud. And now it's more focusing onto its multi-cloud adoption strategy. So under this strategy, it's like basically cross-selling its existing customers, its products to its existing customers, instead of adding in new features. So Salesforce, it has this customer 360 platform where it integrates all of its products under one platform. So this essentially helps its users, mainly because they get a 360-degree view of their customer data through the various segments, through the various departments into the company, as well as it's more cost efficient to them. And also, instead of managing various vendors, they have this one platform wherein just one vendor there, wherein which will provide the different solutions for them. So it's basically gaining traction. The multi-cloud adoption strategy is gaining traction for Salesforce. And the Salesforce, it has also integrated AI across its products, through Sales Cloud. It can generate personalized emails and also provide personalized chat replies. And since the company, it has been providing adding in new features. So over the last recently in last 7 years, the company, it boosted its price for its products by about 9 to 10%. So this was the first price hike in over the decade or so. So this should essentially help to boost its top line revenue. But it should hit its customer base only at a time of renewals over the next 1 or 2 years. So and for Salesforce, lastly, it has been focusing on improving its profitability. So for instance, its operating margin, it's expected to grow by about 3% to 19%, and from 1% to about 15% for its net margin. And this is mainly because it has been cutting down its job cuts. It has been focusing on job layoffs, as well as the consolidating its real estate and carefully spending its towards its sales and marketing expenses. So overall, with a high operating leverage, it's more focusing on its profitability. So overall for Salesforce, we have an accumulated recommendation with a target price of $270. So that's all for me. I would now like to pass it on back to John.
Thanks, Ambrish. So we'll finish up with the next three stock picks that we have. The first will be Alphabet Inc. or Google. When you look at Alphabet, ad revenue has actually been, like I mentioned earlier, ad revenue has actually been steadily improving over the last 3 quarters. In the third quarter of last year, there was about almost a 9 to 10% year-on-year increase in revenue, which isn't really that great. If you just think about it, it's just a number. But when you look at how much has improved from the 2 quarters prior to that, it's still a significant improvement. Furthermore, we do expect this to continue increasing it when their fourth quarter earnings and full year earnings results come out. I believe at the end of this month. With the early signs of industry bottoming, as well as more digital advertising companies having a more optimistic outlook, this definitely should kind of bode well for Google. Just because usually these companies aren't going to say they're going to remain fairly neutral unless they really believe or they're really tilted to one direction, and that's what we're seeing for just the overall digital advertising industry. Why do you think this is beneficial to Google? Is because they essentially are a monopoly in multiple verticals. Think about it, they're the monopoly in Google Maps, Android, Google Search, even your Chrome browser, right? So you've got these monopolies in multiple touch points, which they can all turn into just data points to help their advertising business. And essentially that's what they've been doing. You tag on to that, they continue to integrate a lot of AI into their products, so they're driving better product improvements, and also increasing a lot of monetization for products like YouTube and YouTube Shorts, as well as their cloud offerings. So in terms of cloud, it's tough for them to actually compete with AWS as well as Microsoft, and in some sense they don't directly compete with them because the way they cater their cloud business to it's not so enterprise scale. It's not really a software. It's not really a cloud as an infrastructure kind of deal. It's more of a I guess cloud as a service or productivity improvements tools and so on. So in that sense, they are targeting different group of customers and are actually succeeding in that. Furthermore, over the last year, they've actually had a much leaner cost structure. So this equates to better efficiency. The operating margin is almost back to pandemic peaks of 32%. I think in the last quarter, it's about 28%. They've essentially let go of about 8 to 10% of their workforce and consolidated a lot of office facilities and real estate. So similar to most of the other tech companies. And so we remain bullish on Microsoft on many levels. When you look at the valuations, we essentially just chart here. Right now they're trading at about 23 times for PE, which is if you think about it, it is a little bit above average, but you still think there is some room to run in the first quarter of this year, especially with some early indications that fourth quarter numbers for the holiday season were actually pretty good. We do expect Google to continue kind of riding on the digital advertising trend. It's quite difficult to bet against a company that is a monopoly in an industry that we foresee to have a really good year ahead. And that's why Alpha is actually one of our main picks. I did also want to put in Meta, which is a similar story, but I figured one digital advertising company is more than enough. So we have a buy rating on Alphabet with a target price of $144. Moving to my next company, which everyone have known by now, which is Nvidia. When you take a look at Nvidia, the main thing that everyone's looking at is growth, right? And how sustainable is their growth right now? basically doubling or tripling year on year each quarter. When you look at last quarter's expectation the second quarter expectation for the third quarter of last year, they were expecting maybe I think it was 170 or 180% year-on-year growth. And when numbers came out actually beating that, you would expect fourth quarter to maybe not do as well. But interestingly enough, the expectations for the fourth quarter coming up is actually 231% year-on-year. So they actually continue to increase the revenue growth expectations, which is just crazy. I mean, it's really high expectations. But the good news is that demand is extremely high. A lot of this growth is actually still going to be driven by their data center GPU business, which is their highest margin, highest growth business. Mainly because they have, most of their clients in this business are your large enterprise clients, like your large cloud service providers. Especially as more and more people kind of get more involved in AI, they're starting to invest more in AI. They need the infrastructure to run a lot of their AI programs and algorithms. Right now, essentially Nvidia, has the monopoly in this area to develop the best chips, the most performance, the highest performance, and essentially they sell it at the highest prices as well, and people are willing to pay because demand is so high. At the same time, we're starting to see instead of just your AI related companies or essentially enterprises kind of jumping on the AI bandwagon, we're also starting to see a lot of your sovereign nations come in, and they're starting to have more direct investment towards AI. So they are building out their own database, they're building their own algorithms and models that they are trying to train using AI. And so once you start getting sovereign nations involved, the kind of money that you start pouring into the infrastructure really increases exponentially, and this is really going to be the driver moving forward because AI essentially is the future. How sustainable? We do think that growth for Nvidia at least will be sustainable in the near term. If you're thinking they're going to be growing at 200% for the next 3-4 years, then maybe not. But at least in the initial stages, when everybody is trying to get on the AI bandwagon, we do think that this should be sustainable for at least another quarter or so until they start lapping more tougher comps in the second half of this year, because you naturally you would tend to see your revenue growth rates kind of start decreasing once they start lapping tougher comps, and so that's what we expect. Although we do expect still really high growth for the next quarter. At the same time, the growth is actually increasing. When you look at this chart here, gross margin, which is the line in orange, it's actually been steadily increasing over the second quarter of it says here 2023, but that's their fiscal year. So it's actually like second quarter of 2022, which is 2 years ago now. You can see the gross margins on average are hovering around 60%, but right now it's closer to 75%. So very impressive. They've been able to grow revenue so much and at the same time increase their gross margins. And gross margins are good because higher margin business, you're expanding a higher margin business. It just ultimately expands your margins exponentially. When you look at some of their customer base, we think that it has a very diverse base of customers from different regions. The main concern right now is your export curves from the US to China, and so what these curves have done is essentially they put a lot of restrictions on your high end hardware, higher end semiconductor chips. So all these based on how well they perform, they all need to get certain licenses from the US government before they can ship it over to China. And initially, the thought was that since China makes up about 20% of Nvidia's business, it'd be quite substantial. Essentially they just cut out 20% the whole region, right? But what Nvidia has actually been doing is they've been developing a ton of new chips. They've developed their H20, L20, and L2. Admittedly, they are lower performing chips compared to their H100. But at the same time, it still enables them to kind of maintain their relationships with existing Chinese customers. And so this kind of stops them from, or at least kind of slows them down from moving over to their own Chinese semiconductor manufacturers, because right now, essentially if you cut off a whole region like China, right, they can essentially ramp up their production of similar performing chips in no time, maybe 3 to 6 months, just because there's such a great economy or manufacturing power. And so the concern about weakness from China is offset in essentially two main forms. The first is they've got new chips getting shipped there. Although it will be priced a lot cheaper than the H100, it's still at least some chips are better than no chips. And at the same time, they are seeing a lot of stronger demand from elsewhere to actually make up for the weakness of China. But we think right now, actually, they're relatively well priced at about 40 times forward PE. So it is actually fairly close to its 10-year average of 35 times. But when you're growing at 200% year on year, 40 times forward PE, it isn't really that significant as of right now. Until production and revenue and earnings starts to slow down, then 40 times PE would be look a little bit expensive. But for now, we think it's still relatively well priced. We have a buy rating on Nvidia with a target price of $645. We think that moving forward, Nvidia is really the going to remain the main guys for all of your AI infrastructure in terms of hardware. Now moving on to my last stock pick, which is Tesla. All three of my stock picks I have basically been in line with the sector themes that we've had. When you look at Tesla, you've got superior brand loyalty, and not just for EVs, but also its energy storage business, which admittedly isn't really that popular in Asia, but in North America and Europe, it's actually starting to gain a lot of traction. I think that they maintain their industry leading margin of about 15 to 20% gross margin, which very similar to BYD. But when you look at the overall industry average, it's about 8 to 10 times. So this is almost double the overall average. And like I mentioned, they've been able to do this because of how they've actually designed their manufacturing process. They also have a vertically integrated supply chain, so they're able to manage pricing a little bit more for components, for raw materials, and so on. And they also, when it comes to their factory assembly and manufacturing, they've been able to design parts of their cars that require less assembly. So instead of maybe 4 parts, they just kind of redesign it to 1 part, so that when you assemble, you just need to assemble 1 part instead of 4 parts. These kind of small improvements here and there have really led to huge gains in terms of average cost to manufacture. And lastly, battery tech continues to improve because they're spending a lot of R&D into it and driving down battery costs, which makes a large proportion of overall EVs. And you can kind of see here in this chart, average cost per EV has continued to decline since the first quarter of 2018, from about 75,000 to now roughly about 40,000. So essentially, they're able to lower their prices while not really compromising that much of margins. Imagine if their cost per EV didn't decrease that much, and they still cut prices as much as they did. Actually, their margin would be almost zero. And obviously that wouldn't be sustainable. So we think that aside from these things, you also have your regulatory tailwinds, your net zero emissions that continue to grow and to increase in terms of adoption across countries, across in different regions, and this should only really benefit Tesla and admittedly BYD moving forward. And that's kind of why we like both of these picks, but Tesla mainly because they're a US company that they're mainly listed in the US, and that's why we have Tesla as an accumulate rating with a target price of $240. Yeah, so that's all for our stock picks. I'll now move over to our technical pulse, and maybe I'll pass it on to Zane to kind of run through it really quickly before we get to the Q&A. So Zane?
Thanks, Jonathan. I'll move on to the technicals. Next slide, please. Yep. So for the outlook of the Nasdaq, next slide. Okay. Just a recap of what happened in the last quarter. Actually, we had a very strong rebound from end October. We regained back into this main uptrend channel over here. And then what's positive is that there was a breakout above the 14,400 level, which was quite a strong resistance, I would say. And recently we did a retest, and it was followed up with a bullish candle. So I would think that with this current bullish price action, it's possible for Nasdaq to continue its ascent up towards a test of closer to about the 15,800 or 16,000 level, which was the previous swing high. Yeah. So for first quarter target, it could be around 15,000 to about 15,800 for Nasdaq. Next slide. Yeah, I'll move on to the outlook of the S&P 500. So for S&P 500, it's also bullish. As we broke above the 4,600 resistance level, and we're just hovering in a range consolidation near the all-time highs, which is actually around 4,818 over there. So I would expect if we do hold this consolidation and break up afterwards, we could see new all-time highs for S&P 500. Could reach about 4,850 to about 5,000 in the first quarter. Yeah. But despite all these, despite the current bullish price action, when we look at the Fear and Greed Index, it's currently at around 74 out of 100, which is at greed level, close to extreme greed. So despite the bullish sentiment, I would still think that some caution is warranted in the first quarter as well. Yeah. Next slide. So that's all for me for the technicals. I'll pass back my time to Jonathan to conclude. Thanks.
Thanks, Zane, for the quick TA. If you have any more questions, just feel free to post it in the Q&A, and we'll essentially do a live Q&A, live TA session if you guys want. So just to conclude, we think that markets are getting ahead of itself a little bit in terms of pricing and rate cuts. We don't think 6 or 7 cuts necessarily will happen this year. I think something more like 3 to 4 rate cuts is more like. And what this means essentially is that the kind of gains that you saw in the back half of the last quarter of 2023, you probably have to give back a little bit of that if markets do actually own, or if interest rates do actually only cut about 3 or 4 times. Secondly, the lagging effects of restrictive policies, will still impact growth, especially as we start to see a lot of the repricing of debt and all that kind of take into effect in 2023. At the same time, a lot of as credit card debt kind of starts to expand a little bit and continues to climb, it should see a little bit of a diminishing power in terms of purchasing, because so much credit you can actually obtain. And lastly, we do remain bullish on sectors like the digital advertising, as well as semiconductors, and we do expect it to continue to do well in the first quarter of this year. Momentum for semicons we expect to remain, as well as digital advertising. While for EVs, if you haven't really seen much movement the last quarter or even the last few years, if you take it into account, and we do think that with how they're doing it right now, especially with how much BYD headway that BYD and Tesla are making, we do think that this could be a right time for EVs to kind of explode in terms of price action as well. So with that, maybe I'll move on to some of our questions before we end off the session.